Well, hello and welcome to the Hammond Iles Wealth Advisors Financial Power Hour. We're grateful that you have taken some time out of your day, whether you're here live or going to join us on our video recording of this session. But today we're here to talk about tax saving strategies you can use before year end. So here is just some of the formalities that I want to go over. As usual, Hammond Iles Wealth Advisors does not provide tax or legal advice. So the strategies that we're sharing with you today, we always recommend that you consult with your own tax advisor on how they apply to your individual tax circumstances. But I think that today you're going to receive a lot of ideas on strategies that you can possibly implement in your tax picture to be able to save on your taxes. As always, questions are welcome, and you're welcome to type those into the chat of our Zoom webinar today. Or if you have a question that doesn't get answered today or we don't have time to answer it, you can always send your questions to hello@hiwealth.com, and we'll be happy to answer those questions for you. Now, today we're going to talk about 5 primary strategies to be able to save taxes or income or taxes on your income or your investments to be able to save, and many of them require you to take action before year end. We felt it was very important to get this information out so that you can take advantage of it before the calendar year runs out. Now, there are some things that you can do after the end of the year, and we'll talk a little bit about those, but primarily we're focused on strategies that will be able to enhance your tax filing before the end of the year. Now, the first is when we go into a mall, if you're looking at that information screen, what's the first thing you look at is that little red dot that's saying you are here. And so part of taking a look at ways of saving on your income taxes is evaluating your income. And we're going to talk about that from a number of different perspectives and how you can look at saving money by being aware of where you are in what tax bracket. And not only from an income tax bracket standpoint, but other rates that come into play based on your income. Then we're going to talk about making sure that you're maxing out your retirement contributions, if that applies to you. Also talking about, does it make sense to pay taxes today or now, this year, before potentially saving more later? And also, if you're of the age that you are required to take a minimum distribution, we want to make sure that you satisfy that requirement and make you aware of a way of satisfying that requirement without paying income taxes on it. And then lastly, but not leastly, we want to talk to you a little bit about giving, how you can make charitable gifts once and save twice. So those are the 5 strategies that we're going to talk a little bit about today. So let's start off by evaluating your income, and does it make sense to look at ways of either bunching deductions or using some of these other strategies to move your taxable income in one direction or the other. So when we take a look at the 2023 income tax brackets, what we find is that whether you're single or married filing jointly, although there are other brackets for head of household or married filing separately, but I would guess that most of you fall in one of these 2 categories, that you want to be aware of where you fall relative to these tax brackets. Because especially when we get to the point between the 12% and the 22% tax bracket, you can see that 10% jump in taxable income can really increase your tax liability. So if you fall as a married couple right around that $90,000 adjusted gross income, or right around that $190,000, is there a way to reduce your income to get down into that lower tax bracket, which not only will impact your income taxes, but can also potentially impact your capital gains taxes. So we want to pay attention to these brackets, and we will certainly be happy to share them with you if you'd like to have a copy of your own. But the other brackets that I want you to be aware of are also related to Medicare Part B premiums. So if you're over the age of 65 and you are part of the Medicare system, you also want to be aware that your adjusted gross income, or your modified adjusted gross income, the MAGI, does have an impact on the monthly premium that you pay for your Medicare Part B. So if you're under 103,000 as a single individual or under 206,000 as a married couple, you don't have to worry. You stay with that standard monthly premium. However, if you cross over into a higher level, you're going to see your premiums increase. And this is something that is reviewed each year. So if you have a 1-year spike, you will see your premiums go up, and then it will eventually come back down. But you'll want to pay attention to this, especially if you have a circumstance that will impact your taxes from just a single event. For example, whether you're selling a vacation home and you have a large capital gain, or perhaps you're getting a bonus if you're still working. If it's going to push you over these levels, then we definitely want to look at ways, how do we reduce our adjusted gross income to be able to avoid increasing or impacting our Medicare premiums. Now, one of the other brackets that I think is very important to be aware of is related to the taxation of Social Security. Many people don't realize that there are different levels of taxation on their Social Security. So when it comes into effect, it creates a large tax increase that you go from basically 0% being taxable up to potentially 50%, or even up to 85% of your Social Security taxes. And that is based on what's called combined income, which is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. So that is another calculation that would need to be done just to see where you fall relative to these brackets. For a single individual, if you earn below $25,000 outside of your combined income, then you do not pay any taxes on your Social Security benefits. But as soon as you cross over that $25,000, 50% of your Social Security can be pulled in as taxable. And then if you cross over $34,000, up to 85% becomes taxable. And the same holds true for married filing jointly. If you cross over that $32,000 or $44,000, it becomes taxable. And I want to share with you an example of this just to show you the real impact that that can have. So here are Mark and Barbara. Now, Mark and Barbara, they are age 60 currently, and they are working and have a household income between the two of them of $100,000. Now, when they plan to retire in 6 years at age 66, they plan to maintain their current income of $100,000. So they plan to do that by taking Social Security, which they estimate at being around $46,000 per year. And then they would draw on their traditional IRA or their retirement funds that they have to make up the difference, basically the $54,000. So they would maintain the level of income that they currently have. So let's take a look at how much of that will they have to pay tax on by taking withdrawals from their traditional IRAs versus if they had other ways of drawing income, whether that's after-tax investments or from a Roth IRA. Now, when it comes to the traditional IRA, again, they're taking $46,000 as Social Security income and the other $54,000 out of their IRA. So that $54,000 clearly puts them over the $44,000 that they're required to have that taxation of their Social Security. So as a result of that, of the $46,000, they will pay income tax on $34,000 of Social Security. So if we just look as an overview on their income taxes, they're not only going to pay tax on the $54,000 that they're taking out of their retirement accounts, but they're also paying tax now on the $34,000 of Social Security benefits. They'll have roughly around $12,000 of that they'll receive tax-free without any taxation. Now, on the other hand, if they plan ahead, if they have contributed to the Roth side of their employer retirement account, or they have looked at converting or saving money in a Roth IRA, it provides them some diversification that allows them to draw income from an account where it's not taxable when it comes out. With a Roth IRA, your contributions go in after tax, or when you convert an IRA to Roth IRA, you pay tax on it when it gets converted. It grows tax deferred, and then when it comes out after 5 years or at age 59 and a half, it comes out tax-free. So in the same scenario, if Mike and Barbara, instead of taking $54,000 out of their traditional IRA, they take it out of their Roth IRAs, what we find then is that their combined income is now below the $34,000 of the bracket that would trigger taxation on their Social Security. So look at the savings here is dramatic. So now they're no longer paying the $34,000 tax on the $34,000 of Social Security benefits, and that $54,000 is coming out of their Roth IRA tax-free. So when we take a look at their overview using the Roth scenario, they basically have no taxable income. Their Social Security is excluded from taxation, and the Roth IRA distributions come out tax-free. So they have absolutely no taxable income just looking at these two sources of taxable income. So you can see that whether it's just part out of the Roth IRA or a significant portion of it or all of it out of the Roth IRAs, you can see significant tax benefits. Even if they were to still draw some of the money from the traditional IRA, by having the Roth IRA, they could dial that in so that the proportion of their income coming from the traditional IRA is not enough to trigger the tax on Social Security. So they have that capability. So once we know where we are tax bracket wise, then we can start to do some planning. So until we take the steps of really knowing where we fall or estimate on where we will be for adjusted gross income for this year, then we won't have the ability to plan. So that's the first step, is finding out where you fall with those tax brackets. So in this example, then we're going to talk about a strategy to help get underneath a next tax bracket, and it's called bunching. So what you're doing is taking the ability to deduct expenses on your taxes, and rather than having them in individual years, you're going to bunch them together into a single year so you get the maximum tax benefit. And so here's an example of Sue and Matt. They're a double income young couple that are earning a good income. They're charitable, and they give $15,000 a year to charity. Now, one of the challenges that they face is several years ago, the standard deduction for all of us as taxpayers were increased. So for them, now with the cap on property taxes and state taxes at $10,000, plus their $15,000 that they give to charity, right now their itemized deductions come in at $25,000. However, their standard deduction for 2023 is $27,700. So from that standpoint, they would normally take the standard deduction. So they're not getting any tax benefit from making an impact on the organization or causes that they care about with their charitable giving. So one of the ways that we can do that is by bunching deductions together in a single year. And one way of doing that is what's called a donor advised fund. So as I mentioned, for Sue and Matt, they give $15,000 per year to charity. Now, one of the things that they can do by creating this Sue and Matt's amazing impact fund is to bunch several years together. So in this example, I'm just taking a number of 3 years worth of charitable deductions, or $45,000, to fund that donor advised fund. Now, this can also be used as a great way not only to bunch deductions, but to offset a spike in income. So whether you have a bonus, whether you have appreciated investments that you want to diversify from, but don't want to pay the capital gains tax, or in this case, you just want to have a better tax situation by bunching deductions into a single year, you can contribute an amount to the donor advised fund. Now, the way that the donor advised fund works is that you are able to control it, and you decide when does that money come out. And the way that that works is you basically can go online or make a phone call, and you send in a request to the custodian of the donor advised fund, and then they send out separate donations out to the organizations that you care about. This can also be a great way to simplify your taxes, because if you give to multiple organizations, you can do this with just one gift in and multiple gifts out, so you only have one tax notice to keep track of. Now, the other thing is that you don't have to give the money out right away. You have complete control over when that happens. I'll tell you of one example of a client of ours that sold their business, and so they had a large capital gain by selling their business. So what we did is take part of the proceeds from the sale and funded a donor advised fund to help with a tax deduction in the same year as the sale to help to reduce their tax consequences. Now, for them, they plan on letting that money grow for several years until they retire. And then at that point, they're able to continue their charitable giving out of their donor advised fund without impacting their retirement cash flow. So what are some of the things that this does by bunching your deductions? Well, you get to claim that larger charitable deduction in a single year. So for Matt and Sue, they're able to deduct $45,000 as a charitable deduction in the year that they put that money or the appreciated investments into the donor advised fund. So it gets deducted in the year that you make the gift, even if you never pay the money out in that year. Now, also what that does is it takes 3 years worth of charitable deductions and bunches it into a single year. So even if they use that money to make their charitable giving for the next 3 years, then in those years when they don't get a charitable deduction because they're already using money that they deducted, they're just using the standard deduction. So they're still getting that benefit of the $27,700 deduction as a married couple. Now, again, for tax simplicity, with making that gift, they just have one donor donation letter that they have to keep track of for tax purposes. So when they file their taxes with their accountant, they just provide that one letter that they donated this $45,000 to their donor advised fund. They don't have to keep track of all of the organizations that receive the money from there. Also, it can be a great way to avoid capital gains tax. So if that $45,000 was investments that they originally purchased at $20,000, which normally if they were to sell those funds, they would recognize capital gains tax on that $25,000 of appreciation. They avoid that when the investments are sold inside the donor advised fund. So it allows them to avoid capital gains if they are funding it with an appreciated investment. And as I mentioned earlier, the donor or the couple gets to control the investing. So if that is a single investment that comes in, it could be sold and diversified into a more broadly diversified portfolio and can grow in that donor advised fund either until they give it all away or they pass away and designate that the remainder goes out to charitable organizations. And there's no requirement that any funds have to be paid out in any year, so they could grow beyond their lifetime. You can actually pay out to multiple organizations, and you can actually set up your donor advised fund to pass on to the next generation if you want your children or grandchildren to continue giving from your donor advised fund. So that's one way to take advantage of looking and knowing where you are in your tax brackets on being able to bunch deductions together to be able to lower your taxable income and potentially pay a lower tax rate. Now, one of the other ways of doing that is if you are still working and have earned income, whether that's as a W-2 or 1099, you want to make sure that you're maxing out your retirement contributions. For employer retirement plans, for those under the age of 50, you're capped out at $22,500 this year. If you're over 50, you have a catch-up contribution, so you can add an additional $7,500. So a total of $30,000 this year. So if you're expecting a bonus or just have some additional funds that you have available, one way to reduce your taxable income is increase your contributions before year end to take advantage of any room that you have that you could contribute to retirement plans. And that also goes for simple IRA plans where a little bit lower caps of $15,500 with a catch-up of $3,500. Now, also, even if you have a employer plan or you're working somewhere where you don't have access to a retirement plan through your employer, you can still set money aside into retirement accounts, whether that's a traditional or a Roth IRA. This year, the maximum contribution is $6,500. And again, if you're over age 50, you can add an additional $1,000 to max out that contribution. Keep in mind, though, that to contribute to a traditional or a Roth IRA, you must have earned income. So Social Security or a pension, that does not count as earned income. And your modified adjusted gross income has to be below certain thresholds to be eligible to contribute to a Roth IRA or a traditional IRA. And contributions, this is one example where you don't necessarily have to take action before the end of the year. You will be able to make contributions to traditional or Roth IRAs up until Monday, April 15th of 2024, and have it still count for your 2023 tax year. Roth IRAs are a type of account that I recommend to everyone. If you're eligible, I can't imagine why you would not put a contribution into a Roth IRA. As I talked about earlier, it allows you to diversify your income in retirement. It grows tax deferred and all comes out tax free. If you're under 59 and a half, you can always take your contributions back out if you need them without any penalty or income taxes. So let's talk about strategy number 3 does it make sense to pay taxes now to potentially save more later? And here are some of the things that I just want to point out that I'm sure are probably weighing on your mind that you may be aware of or not aware of, that I think points to the fact that income taxes will have to go up at some point. Right now, the Congressional Budget Office recently released a projection that Social Security will basically run out of money in 2033. So in 10 years, we're expecting that the amount of money going out of Social Security will exceed what's going in and basically drain the pool of money available. Also, we just crossed over the last fiscal year for the federal government, which operates on a September 30th year end. And this final monthly U.S. Treasury statement for fiscal year 2023, as of September 30th, showed a 1.7 trillion, with a T, $trillion deficit for the last fiscal year. So that now brings us as a national debt up over $33 trillion that we have spent more than what we've received in taxes. So that will continue to weigh on the federal government, including what is now going to be one of the fastest growing expenditures over the next decade. As we have seen interest rates go up dramatically from 0 to over 5%, the federal government is now being required to pay more and more interest on that national debt. And the Congressional Budget Office is now estimating that over the next decade, we will pay $10.5 trillion just in interest on that debt. That's not even paying down the debt. So by that point, just the interest on our national debt will exceed the defense spending for the next decade. And one of the additional things that may not impact you unless you've recently inherited a retirement account from a parent, or you're anticipating inheriting an account from a parent, is that non-spouse beneficiaries no longer have the ability to stretch out IRAs. Part of the Secure Act that was passed in 2019 now states that all non-spouse beneficiaries will have to take out all of the taxable income out of an IRA within 10 years. So the ability to stretch that out longer is now gone. So whether it's going to impact you on inheriting funds, or if you're planning on what's going to pass on to the next generation, that's something to become aware of. Now, when we take a look at the historical federal income tax rates, they've been as high as 94%, but right now the highest tax bracket is 37%. So the question becomes, when we have all this debt to pay, would you anticipate that at some point in the future, we're going to have a higher income tax bracket? Some say yes. Some say that, the growth of the economy will get us out of that, or they'll figure some other way to start saving money and paying down debt. But one way or the other, that debt will need to get paid. So when we're looking ahead and we're talking about a strategy about converting traditional IRA or a 401k or a 403b or any pre-tax retirement account, does it make sense to convert it to a Roth IRA? When you do that, it becomes taxable income at the point that you convert it. It grows tax deferred from that point forward, and then all comes out of the Roth IRA tax-free after 5 years or age 59 and a half. Actually, age 59 and a half and 5 years. So if you're 60 and you convert to a Roth, you need to wait 5 years before the growth and interest can come out tax-free. Your contributions can always, or the amount that you convert can always come out tax-free. So if we anticipate that tax rates are going to be higher in the future, then it would be to our best interest to pay the tax now. And if they're going to be the same, then it doesn't really matter. Although I would say that earning tax-deferred growth in a Roth IRA and having it tax-free is a benefit. But if tax rates are going to be lower in the future, and that may not relate to Congress setting the tax rate, but it may relate to the fact that you anticipate when you retire, your amount of income is going to go down just by the sake that you're a high income earner or you're a double income earner now, and you anticipate your retirement living expenses to be lower than what you're earning right now, then it might make sense to stay in the traditional IRA and pay tax on that money later. But there are a lot of other things that we want to take a look at in making this decision on whether a Roth IRA conversion makes sense for you. One is looking at retirement income. We looked at Mike and Barbara at the beginning of our presentation today, and the fact that they could draw from a Roth IRA rather than a traditional IRA, save them not only the taxes paying on that income, but also taxes on their Social Security. So Roth IRA distributions can help reduce the taxation of Social Security income in the future. Also, as I mentioned earlier, it allows you the opportunity to diversify your income. So even if you're drawing some from Roth and some from traditional, it allows you to dial that in to the level of income that you want to have in any one year. Also, you may look at the fact that here we are at a point where the markets have gone down in value after going down in 2022. Values of investment accounts may be lower at this point in time. So it may be an opportunity to convert an IRA to a Roth IRA at a point where the investments are at a lower point of growth in the market trajectory, which over time we know will always be up. But right now, with circumstances, the markets have pulled back. The other is related to legacy building. I mentioned earlier that beneficiaries no longer have the ability to stretch out an IRA. So by leaving your beneficiaries a Roth IRA versus a traditional IRA, you're leaving less taxable income for them in the future. Also, whatever you convert to a Roth IRA, there are no required minimum distributions. So it could also assist you in making sure that you have lower income in your retirement. There is a strategy commonly referred to it as making conversions in the valley, because many times retirees will see a dip in income between when they retire and when they hit 73 and start taking their minimum distributions, or potentially when they start taking their Social Security later if they're able to defer it. You have a window of time that may be a few years or just a year or two where your taxable income may be lower in that window before you're required to take the minimum distributions, which can push up your taxable income. So by transitioning more of your pre-tax dollars in a traditional IRA or retirement account into a Roth IRA, it allows you to reduce your required minimum distribution, and it can lead to more being left over to pass on to the next generation. So let's take a look at an example of a couple and how this could play out. So we have Arthur and Michelle, and both of them are age 73. They realize that they're not going to need all of their retirement savings. They've been very diligent savers and have accumulated assets in their retirement accounts that they realize that they're not going to necessarily need it all. So they want to look at how do they maximize the legacy that they're going to leave to their son. So in this case, and this example, Arthur is going to convert $200,000 of his traditional IRA into a Roth IRA. Now, for the simplicity of this example, we're going to assume that he has the taxes withheld from that conversion at the time that he converts it. So if we're estimating that he has 25% in income taxes, and so he'll pay roughly $50,000 on that $200,000. Normally, I would suggest that you convert an amount that you can pay the taxes outside of the retirement account, just so that you can maximize the amount that's in the Roth IRA. But certainly, we'll see that this still has a benefit, even though they're taking the taxes from the conversion amount. So assuming that he pays that income taxes, then he's basically going to start his Roth IRA with $150,000. So again, our assumptions is that between his federal and state income taxes, around 25% taxes, that the growth of the account is going to be what I would say is a conservative balanced allocation of around 6% per year. and that his RMDs are taken out on January 1st. Just makes the math a whole lot easier. So when we take a look at the picture, Arthur lives another 6 years and passes away at the age of 78. So he has 6 required minimum distributions at 73, 74, 75, 76, 77, 78 that come out. And after tax, that calculates out to being roughly $39,000 after taxes. Now, with that 6% growth on that $200,000, even after taking the minimum distributions out, when he passes away, the value of his traditional IRA is $220,000. Now, on the other hand, he decides to take that $200,000 and convert it to the Roth IRA. And as we talked about earlier, he's going to carve off the $50,000 right off the top to pay the income taxes. And so he starts his Roth IRA with $150,000. Now, because a Roth IRA comes out tax-free, there are no minimum distributions. So during his lifetime, that $150,000 grows at the 6%, same as the traditional IRA. And when he passes away, the value is just under $213,000. So he's more than regained what he paid in income taxes, but it's slightly less than the pre-tax number in the traditional IRA. Now, upon his death, he leaves it to his wife, Michelle. So Michelle gets those amounts, and we're going to take a look at what it would look like under both scenarios for her. So she lives another 9 years beyond Arthur, and so she passes away at age 87. So she has 9 years of required minimum distributions, and over her lifetime, that calculates out to being roughly $86,587 after taxes. So for her, when she passes away, the value of her traditional IRA is just a little bit lower. So the account almost kept up with her minimum distributions, and she leaves $218,370 to their son, Arthur Jr. So on the Roth IRA side, again, because there are no minimum distributions during those 9 years, it's just allowed to grow. So from the 212, when she passes away, it's now worth over $359,000. So now Arthur Jr. starts to inherit those accounts. Now, again, in this case, because of the Secure Act, he is required as a non-spouse beneficiary to draw all of the amounts out of the retirement accounts within 10 years. Now, because the traditional IRA now has a value over $200,000, he doesn't want to take $200,000 out at one time. So he decides that he's going to take it out 1/10 of the value every year for those 10 years. So he divides it out and basically takes out the balance divided by the number of years remaining. And that's how he calculates what he takes out every year. So after taxes, and it grows what's remaining in the account at 6% per year. After distributions, after tax distributions, total around $216,000 for Art. Now, on the Roth IRA side, there are no minimum distributions, and the entire account balance will come out tax-free. So because it comes out tax-free, it doesn't make sense to take it out anywhere earlier than in the 10th year. So Arthur Jr. can just allow the account to grow for the full 10 years and then take out the entire account balance in year 10 when he's hit the end of that 10-year stretch for the Secure Act that he has to empty the account. So at that point, growing at 6% per year, his Roth IRA is now worth $643,000. So what you see here is by making that conversion early and having the Roth IRA grow where minimum distributions aren't required, they're able to leave 3 times the amount after taxes to their son because of that planning and paying the tax early, which saves them the taxes later. And one of the things that I'd also would coach Arthur Jr. about doing is during those 10 years, If he doesn't have the money in his own account or the ability to contribute to his own Roth IRA, he should be taking money out of that and then making sure he's maxing out the contribution of his Roth IRA each and every year if he's eligible. But just looking at the two scenarios with the different IRAs, you can see a significant difference in what passes on to the next generation. So when you're converting from a traditional IRA to a Roth IRA, again, we want to be aware of where you are with tax brackets. So that may be a factor to consider on how much you convert from a IRA to a Roth IRA. Is it going to push you into a higher tax bracket? How much room do you have? And this is where your tax advisor can be a true resource for you to tell you on what that amount may be. Now, if you're under age 59 and a half, normally when you take money out of an IRA, you would pay a 10% early withdrawal penalty. One thing to be aware of is that converting from an IRA to a Roth IRA before age 59 and a half, you are not subject to the 10% early withdrawal penalty. However, if you do use some of that conversion amount to pay the tax on it, it will be subject to income taxes on the amount that is used to pay the income tax. So if in our example for Arthur and Michelle, if Arthur, when he converted that $200,000 to his Roth IRA, if he were, say, age 58, he would pay income taxes on that $50,000 that he was using to pay the tax. So it's tax on the money that he's using to pay the tax. And that's one of the reasons why we don't normally recommend paying the taxes out of the conversion amount. Now, the conversion amount must be completed by the calendar year. So unlike contributions going into a Roth, you have up until April 15th. For conversions, it needs to be done within the calendar year to count for that calendar year tax. Now, conversions are, again, most effective when they're paid from outside sources. And just be aware of surprises. And that's why I shared those brackets for Social Security, as well as those Medicare premiums. You have to be aware of converting amounts. Is it going to have an impact on your Medicare premiums? In some cases, you may say, well, let's convert a larger amount now, so I will pay higher Medicare premiums for a year, and then my income drops back down and my premiums will drop back down, rather than, say, converting my IRA over a period of years. But it's a conversation for you to have with your tax advisor to take a look at what might be most advantageous for you. So we're in the home stretch, looking at the last two strategies to save on your taxes. How about satisfying your required minimum distribution without paying any income taxes? Sounds like a kind of a win-win. Well, one of the ways of doing that is what's called a qualified charitable distribution. And so if you are age 73 or older, you will be subject to required minimum distributions. This was changed as part of Secure Act 2.0. They pushed the RMD age up. One of the easier ways of looking at it, rather than using the years that they mention in the legislation, is if you were born between 1951 and 1959, you're now going to be subject to RMDs at age 73. If you're born in 1960 or later, that is now pushed on to age 75. And if you're born before 1951, you started to take minimum distributions either at 70 and a half or at age 72. So if you have minimum distributions, so Uncle Sam gets tired of waiting, so there's a percentage of your pre-tax retirement accounts that has to come out and trigger the tax on it. You can turn around and reinvest it if you'd like, but it's required to come out and at least trigger the income taxes on it. And one of the ways to avoid paying tax on that is through a qualified charitable distribution, or what's called a QCD. Now, the way that that works is that individuals over the age of 70 and a half, and this is one of those things where they made a change to the RMD age but the age for qualified charitable distributions remained at 70 and a half. It did not change. So you can start to use this strategy at age 70 and a half, even if you're not subject to minimum distributions yet. But you're able to distribute up to $100,000 per year directly from an IRA to a 501c3 charity. Now, by doing so, it's not reported as income, but also it's not deductible as a charitable deduction. So one of the things is if you're not getting any benefit from your charitable deductions because you're using that standard deduction, this can be a great way of making a charitable impact and getting some tax benefit. So the QCD counts towards your minimum distribution. So if you have a minimum distribution of $10,000 this year, for example, and you make a gift of $10,000 from your IRA to your favorite charity or charities, that $10,000 is not taxable when it comes out of the IRA. You don't get the tax deduction for the charitable donation, but it does count towards your minimum distribution. So you cover your minimum distribution without paying the tax. Now, one added benefit, if you happen to be living in a state that has state income taxes, most states use the federal adjusted gross income to calculate the state income tax. So if you make a charitable gift out of your IRA and it's not reported as income, you are basically lowering your federal income tax when it is ultimately then also saving you state income tax. So you get a kind of a double win there if you're using a qualified charitable distribution. Now, also effective this year in 2023 is that you can make a one-time donation of up to $50,000 to a split interest entity. And some of those are referred to as charitable remainder trusts or charitable gift annuities. So ways that you could actually create retirement income coming back to you with ultimately making an impact on an organization or cause you care about. I'm happy to talk about that in more detail if you'd like to learn a little bit more about that. And then starting next year in 2024, that $100,000 limit will increase for inflation. So that will go up each year. So this can be a great way to make an impact while doing so with pre-tax dollars so that you never have to pay the tax on it. So the last strategy that we want to tackle is how do you give once but save twice? Now, for most people, when you get approached towards the end of the year, a lot of charities are asking for year-end gifts. Normally, you're thinking, if I make a gift, I have to give cash. I'm pulling out my wallet and giving cash or charging it or sending them a transfer on Venmo. We're using cash to make charitable deductions, when actually a smarter way to make those charitable donations is through an appreciated investment. It allows you to give once and save taxes twice. And I want to share an example with you on how that works. So here is an example of a stock. You purchased it back in 2015 and paid $20,000 for it back then. And as of the end of September this year, it's now worth $45,000. So you've seen some nice appreciation. So now you have unrealized capital gains. So just to make the math easy, let's say that you want to make a $45,000 gift to charity. Now, if you sell that stock to free up the cash, thinking that you have to write a check, you would pay capital gains tax on that unrealized capital gain. So you would pay either 15 or 20% potentially on that $25,000 of appreciation before then making the gift. Now, one of the ways around that is to donate the stock directly to the charity. When you do that, you get a full tax deduction equal to the market value of the investment that you're donating. As long as you've owned it for at least 1 year, you get the full market value of the donation. So in this example, they would get a tax deduction of $45,000. Now, also, you have that additional savings is that you don't pay any capital gains tax on the $25,000 of appreciation. So you're saving not only on the deduction, but also you're avoiding that $25,000. Now, in some circumstances, people come to me and they say, Greg, it's a great strategy, but I really love that stock or that investment or that portfolio. Why can't I just keep the stock? Well, what I would suggest in that example, rather than donating the cash to charity, donate the $45,000 in stock in this example, and then use the $45,000 in cash that you were going to give to the charity and buy the stock back. If you want to keep that investment, you have it, but now your cost basis steps up to the current value, and you have avoided the tax on that appreciation. And then lastly, it allows you to diversify if that donation goes into that donor advised fund that I talked about earlier. So you have an opportunity that if you want to reduce the risk in your portfolio by not owning an individual stock, you could gift it to a charitable fund like a donor advised fund, and be able to diversify your investments inside the fund without the capital gains. So here's what the 5 strategies have been. We wanted you to stop and take a look at where you are tax-wise relative to your tax brackets. If you're over 65, are you going to impact your Medicare premiums? And if you're receiving Social Security, are you going to trigger taxation on your Social Security benefits? If so, then you may want to look at bunching your deductions, possibly bunching charitable deductions using a donor advised fund to be able to reduce your taxable income. Another way of reducing income is if you're still working, max out your retirement contributions. I always recommend maxing out a Roth IRA if you're eligible, so you want to make sure that you make those contributions before April 15th of 2024. Also, does it make sense to pay taxes now to potentially save yourself and your beneficiaries taxes later? So you may want to take a look at a Roth conversion. Does that make sense to do in your financial picture? Also, if you are of age that you're required to take a minimum distribution and you haven't taken it out yet this year, does it make sense to use a qualified charitable distribution to make an impact on an organization without recognizing that RMD is taxable income for you? And if you are going to make a charitable donation to charity before year end, consider giving appreciated investments rather than cash. Avoid the capital gains on that appreciated investment and save the cash for you or to buy back the investment if you want to keep the portfolio running. So those are our 5 strategies to save you on taxes before the year end. I'd like to tell you just a little bit about how we can help. If you're new to Hammond Iles, we can help you by these monthly financial power hours that we host. All of the power hours are recorded and are available on our YouTube. So I encourage you to go to YouTube and search Hammond Iles, and you'll see all of our video content, both our power hours as well as our monthly Financial Friday video series, which are just financial tips in under 60 seconds that are released every Friday. And those are also available through our social media. So make sure that you follow us on Facebook, connect to us on LinkedIn, or like us or follow us on Instagram. Also, there are a number of resources available for free for you on the Hammond Iles website, which is hiwealth.com. One of the more popular ones that are available there is our Family Inventory Workbook. So if you're looking for a way to centralize the information for your children or your beneficiaries, that if something happens to you, who are your advisors, what are your investments, what type of insurance do you have, all of that information can be gathered in your Family Inventory Workbook. And lastly, if you have a situation or a question that is unique to you and you'd like to have a conversation, please don't hesitate to reach out to a financial coach at Hammond Iles Wealth Advisors. You can go to our website at hiwealth.com and click on the button in the upper right-hand corner for a free 15-minute conversation. We'll be happy to answer any questions that you might have. So with that, I'd like to thank you for joining us today. And as always, we're open for questions. I'll be happy to take your questions. You can type those in the chat. If you have any questions about strategies to save on taxes before year end. If you think of a question after our workshop, or if you're watching this video and have a question, please send that in to us at hello@hiwealth.com. We'll be happy to answer that for you.